welcome back to my channel. This is Blood Phantom 81. Today I'm going to be talking about 4 hot stock picks for the month of November 2019. So the first thing I want to go over is some of the stocks that I recommended in my last video. That video was released on October 12th. So if we take a look at the first stock I recommended, which was NVIDIA, we can see that since I released that video, it's grown about 13%, and I 85, and I'm currently up about 13.6%. And as you guys can see, most of my purchases came towards the middle and end of October, so 6 shares here on October 14th. The next stock I recommended was Square, and I'm currently up about 10% on Square. Interestingly enough, I felt that the technical setup on NVIDIA was a lot better than Square, but I ended up buying more Square than NVIDIA. So I have about 40 shares, average cost at about $61.23, and my equity sits at around $2,700. And a few days after their earnings were released, they actually did pretty well. And in the past month, Square is up about 14%. The last 3 stocks you can find on my dividend growth pie on M1 Finance. I'll be sure to link it in the description down below. The 3 holdings were 3M, Johnson & Johnson, and Caterpillar, which actually represent a large chunk of my entire portfolio. So they're actually all in the top 4 in terms of my largest holdings on this dividend growth pie. So obviously I like these companies a lot. On 3M, I'm currently up about 5%. On Johnson & Johnson, I'm up about 4%. And on Caterpillar, I'm up close to 25%. So the first stock to kick off the list is McDonald's. And over the past 5 years, it's actually gone up close to 98%. So it's almost doubled. And if we take a look at some top level financials, their dividend yield currently sits at 2.6%, P ratio of about 25, and a P ratio of about 25 is definitely not undervalued by any means, and 25 might even be a little bit overvalued, but that's sort of the price that you have to pay for a premium quality company like McDonald's. Market cap at about 145 billion, which is definitely one of the largest QSR stocks out there. And for those of you that don't know what QSR is, QSR basically stands for quick service restaurants, or basically like fast food. And so McDonald's is definitely a leader in their fast food space, in my honest opinion, as far as the public companies go. So taking a look at McDonald's from a technical perspective, we can see that they're definitely still in an uptrend. And so this blue line that I have here represents the 200-week moving average. In my opinion, the 200-week moving average is one of the most important long-term averages for any company. And so McDonald's is no exception. As you guys can see, for a very long time, even if I zoom out back to, let's say, 2004, we can see that McDonald's has held above this moving average, and it's even acted as support a lot of times. And in my opinion, one of the big reasons for this drop that we had recently is because how inflated McDonald's was compared to its 200-week moving average. And so if we take a look at how much it's dropped, so the 52-week high is here at about $221 per share, and recently it's dropped all the way to about $193 per share, which is a drop of about 13%. And in my opinion, McDonald's can keep on dropping, to be honest, but one of the reasons why I'm buying now is because of the 100-week moving average. And so I would consider this to be like level 1 support, which is the 100-week, and level 2 support to be the 200-week. And so even if we break this area, which is the 100-week, I will be buying a lot heavier. But for the most part, like I said, McDonald's is in a long-term uptrend, and over the past several years, they've enacted a lot of share buyback programs. So in my opinion, that's a big reason for the recent run-up ever since 2016. If we take a look at its price history, let's say since 2009, I think it's pretty interesting actually. So during the 2008 recession, they didn't actually lose all that much value. They went from about $65 per share all the way to about $47 per share, but the $47 per share period only lasted a week. And so for the most part, they went from about 65 to 51, if you're not including a few of those days at the very, very bottom. And that's definitely a lot better than the rest of the market, to be honest. But excluding that period, they basically have had, I would say, like 3 different phases. Phase number 1 is from 2009 all the way to 2012, where McDonald's went from about $50 per share all the way to about $100 per share, so basically doubled. And then for the next 4 years or so, from 2012 all the way to 2000, let's say 15, so let's say maybe 3.5 years actually, 3.5 years, McDonald's just went sideways. And then ever since 2015 all the way to 2019, McDonald's basically over more than doubled. And so that's basically the three phases that we're at right now. And so it's tough to know exactly what phase we're in my opinion. I'm not really trying to make that guess. I'm just trying to get into a high quality company whenever a good opportunity presents itself. And that's currently where we're at right now. So I've recently purchased McDonald's. I have about 10 shares. My average cost is $191.13, and so my total equity is about close to $2,000 actually. So I really like McDonald's right now. The next stock on the list is Starbucks, and so Starbucks is pretty much paying out a 2% dividend yield. The PE ratio is actually pretty high, similar to McDonald's, in that I'm not sure when we would get a point where I would consider Starbucks to be undervalued, just because it is a high quality company. So the PE ratio isn't the best. Market cap currently sits close to $100 billion right now. So it's actually pretty similar to McDonald's in terms of size. However, I think we're actually catching Starbucks in a growth phase at the moment. And if we take a look at it from a long-term perspective, so it's actually pretty similar to McDonald's in a lot of ways, in that if we go back for a second, we can see that over the past 5 years, it's pretty much doubled, similar to McDonald's. And also similar to McDonald's, I would say Starbucks has had three phases. They've had an expansion phase ever since the 2009 bottom. They've had a sideways consolidation phase ever since 2015, all the way to about 2018. And then towards the middle of 2018, basically Starbucks just took off, and it went from about $48 per share all the way to $100 per share, which is more than doubling itself. And so also similar to McDonald's, Starbucks is currently showing about a 16% discount from its all-time high. And so I'm basically not taking any chances at the moment. Yes, Starbucks could drop a lot, especially because I think the long-term moving averages need to catch up a little bit. But if we zoom in a little bit more to a daily time frame, we can see that we're butting up against 200-day moving average support, which is basically this blue line, and it's acted as support ever since the recent expansion phase here towards the middle of 2018. Take a look at RSI. RSI did go below 30 ever since the start of October, and it sort of was hovering around that area. So anytime you have a high quality company that is retesting the 200-day and RSI hits 30, in my opinion, that's a buy. And so yeah, Starbucks to me was a no-brainer. Taking a look at some top level dividend financials, we can see that their payout ratio is a healthy 53%. The 5-year growth rate of the dividend yield is actually really great at about 24%, and their dividend growth has been increasing over the past 10 years. So 10 years is basically no match to McDonald's, let's say 43 years. However, I do think that Starbucks will be a dividend aristocrat in the future. Obviously, there is a little bit uncertainty because they are in a very cyclical sector. Starbucks is similar to, let's say, something like Nike and Amazon, in that they are in the consumer discretionary sector. So that is one bearish case for them being able to be a dividend aristocrat. But I think they'll be there, in my honest opinion. And they, like I said, they currently pay close to 2% dividend yield. So this dividend yield plus this growth rate is a very, very awesome combination. And so I'm liking Starbucks a lot. The third stock on the list is LTC Properties, or ticker symbol LTC. So LTC is a healthcare REIT. They basically lease out a lot of properties to those that need medical and healthcare services. They also provide a lot of properties for senior housing. So if you are interested in companies like that, then consider looking into this one. Over the past 5 years, they've only gone up about 10%. But the main reason to buy LTC is for the fat dividend yield, currently sitting at about 5%. P ratio is about 18.9, but I wouldn't put too much weight into this, especially because it is a REIT, so the financials are a little bit different. Market cap is actually pretty small at only close to $2 billion actually. But one fun fact that I found is their company is actually really lean. So they currently only have 21 employees, which I think is pretty cool. And this is actually confirmed through multiple sources. LTC is not scared to grow in the form of acquisitions, and they basically consider merger and acquisition investments as a component of their operational growth strategy. So taking a look at LTC from a long-term perspective, I think there's a lot of parallels today as their war to basically the 2008 recession. And so around the 2008 recession, we had what looked to be sort of an ugly inverse head and shoulders pattern, where basically we had one attempt of getting through resistance, we got rejected, we got a second attempt of getting through resistance, we got rejected even further, and then we had basically like a third or fourth weak attempt, another rejection, and then we finally broke out to the upside. And then this area continued to act as support once we broke above it. As you guys can see, we did retest that area. And so I'm seeing something really similar right now. Let me go ahead and get rid of the moving average, because I think with high dividend monthly payers, moving averages aren't so important as much as the sentiment. And at the moment, I think we're getting a pretty similar pattern. So we had one rejection off of this $52 area. And then after we pulled back a little bit, we had a second attempt to break out above this area. And then we got rejected even further. And then we had a third attempt, we had another rejection. And I think it's possible that we consolidate around this area a little bit before breaking out to the upside. And I'm actually anticipating a little bit more consolidation to go. So I think there's still a really good buying opportunity. We take a look at how much it's dropped from its 52-week high. We've gone from about $52 per share all the way to about $45 per share. So that's a decrease of about 13%. And then taking a look at my position, so I'm actually down 4%. I have 40 shares here. My average cost is about $47, which is above the current share price, and that's why I'm down. My equity is about $1,800, but I actually plan on buying about $500 more worth of this company. So that's basically 10 more shares over the next week to average down a little bit. The last stock on the list is Uber Technologies. And so just as another disclaimer, obviously Uber is very speculative and I don't consider it as reliable as the first two companies especially. But my investment philosophy is pretty simple when it comes to these speculative types of companies. Basically, I believe in Uber and I believe the industry that they're in, which is basically rideshare. I believe in autonomous transportation and other forms of hands-off transportation. I think that's the current trend of the population basically in the US and the rest of the world as well. But I also believe in Uber's ability to capitalize on the current growth prospects, which is what we have right now, but also the future prospects. I think that they will be a leader in autonomous driving in the future. Obviously, there's a little bit of competition with companies like Lyft. I'm sure we'll have another tech giant like Google trying to get their hands on this type of industry. Maybe it's Google, maybe it's Amazon, I'm not sure. But I think Uber has a leg up on a lot of their competition. And there's plenty of basically these kinds of services to go around. So even if there is competition, I think that's totally fine. If anything, that's probably healthy in order for these companies to be more efficient and be safer and just be better in general. And so that's my investment philosophy. I know that Uber basically tanked a little bit after its IPO. But one thing's for sure, and that's with a lot of these high-flying growth companies, things like Facebook, things like Amazon, and other types of IPOs, I think maybe even Netflix, it's super common for one of these companies to basically soar, let's say 40%, and then tank afterwards. So let's go ahead and take a look at their long-term chart. So I will actually make more of an in-depth video about this in the future. But if we zoom out a little bit, and this is basically my idea with IPOs, it's super common for IPOs to basically take off about 40+% and then tank afterwards. And Uber is no exception. We had a really strong drop here in August, and then it's just been like waterfalling downwards. But the drastic drop in share price is exactly what prompted me to buy. So I'm basically up about 7% on Uber already. I have 30 shares here. My average cost is about $27.58, and my equity is about $800. And so, yeah, with Uber, I think it is a speculative buy. I think either Uber or Lyft, you can go wrong with either one of them at these prices. I know that Lyft has performed a little bit better than Uber. So if you want something that may not be as overpriced as Uber, because to be honest, Uber's market cap is pretty ridiculous. It's currently at about $50 billion. For a company that's not super close to being profitable, that may not be reasonable for a lot of investors. So, absolutely no shame with going with something like Lyft. But yeah, for the most part, I like Uber for a long-term hold. And so that's going to wrap it up for this video. So one thing I want to say is the camera quality isn't all that good, and that's because I recently got a new laptop, and just like recording with my old camera causes my laptop to lag a little bit, and it's pretty annoying. So yeah, I'll see if I can keep figuring that out, but it's possible that we just get these kinds of videos. The quality isn't too bad though, because I do have my microphone. But anyway, I bring this up, just comment down, let me know if you guys noticed the difference in quality, and if I should keep on figuring stuff out. But yeah, with all that out of the way, thank you guys for watching, and I'll see you guys in the next